So we're not going to do an intro for every panel, but given that our next moderator is one of my mentors, I figured I could come up here and maybe, slightly embarrass him as I introduced him. But I think many of you in the room know Brad Levy. Brad and I worked together at Goldman, where I think 2 weeks into the job, he took me out to lunch so I wouldn't blow up in terms of just not knowing the Goldman way of doing things. And he's been just a really kind and supportive person in my career. So I'm really happy that he's actually leading what I think is one of the most important discussions for people that know Viable Markets and know any of the other initiatives that we're involved in. We're a big believer in data. My personal view on crypto markets is that, or any market, is that until you get the data organized, the market really can't evolve in a sound fashion. So this panel is this is one of our first panels that we put together, and we're really excited about it, especially now that we have Brad leading it. But Data in the New Oil is next, and I'd like to welcome Brad and the rest of the panelists to the stage.
Thank you. Just this, right? Okay, great. Thank you very much, Chris. Too kind. Chris and I go way back and are inside disruptors in my words. So great event today, Chris, very timely. I would say it's definitely crypto evolving. It is almost by definition never evolved in the past because it will always be evolving, and we're certainly in that phase right now. So just data is the new oil as a topic. Data is obviously a controversial topic these days in the world. It's become that in the last decade or so. Oil has been a controversial topic in the world for decades and decades, and you add the word crypto to that, and it's the triple threat of emotion. So great topic, great timing. Today you've heard Bitcoin around 10 years. Distributed technologies have arguably been around for 30 plus years. But to Tim's comments early on, are we evolving? Is price the only metric? It's a fragmented market, rife with fraud. Do we need a lot more regs? All great questions. Is it a currency? Is it a security? Is it a derivative? The answer for most is some version of yes. And around all of this, data is just the critical component to developing this market over time. So it is early days for this market in our panel's opinion, and you'll hear that today to varying degrees, whether it's the assets or instruments that we're trying to define, a Bitcoin, a Libra, a finality, a token, whatever these words mean, we'll be defining them in data. The participants in the markets, the roles and the rules, and the infrastructure and the tech to support it. This continues to draw a huge amount of attention globally, this whole topic, and for good reason. It does involve general commerce. This is just not about financial markets. This is about people and the unbanked. And if you've heard the Libra and the Facebook pitch, it's certainly more about that in their mind at this point. It's about privacy. You heard that on the legal panel. It's about your rights as a person to be private or to transact where and when you want. So it's about banking and it's about data rights. And it is about the technology on some level, the distributed ledger, and the ability to leverage that over time as a more efficient way to deliver technologies. But first and foremost, and that's what this panel is about today, it is really about reliable and trusted data. Again, in an always evolving market, it will always be changing, so there's always an element of distrust or mistrust when things are changing. But because there are so many things changing at the same time beneath our feet, including the world, this topic will not see the end of debate anytime soon, nor an evolution. So whether it's the way we describe things, the things we're trading, the people trading them, or the places in the world, the market itself, the liquidity, the venues we're trading on, et cetera, or the tools we're using, or the history of it and the modelability of the forward, the risk, the pricing, and the compliance. So the availability of more data in the space will help fuel things. The markets and the market participants, for short, will grow. The increase in the size of the market, as well of its importance to the traditional financial markets. And there will be areas where crypto leverages what exists today, blends with what exists today, or invents net new. So with that, you'll have some surveys up on the screen. They're on Slido. You can just go to that website and take the survey when it pops up if you can. It'll be great information for all of us later. We may have some time for some questions at the end. We'll see. We did miss one of our panel members who got stuck on some personal items, Rui from ICE. So we're 3 plus me today. So I'll start. They'll do some intros as they give their first answers to some basic big picture questions. But Dave, you've been laser focused on the crypto space and the data. You're a pretty prolific writer about it and generally don't hold back. But before going deep there, you will have a chance. Just help set the discussion up today a little bit by framing where you think we are in this developing market, assuming that it is a developing and not a developed market.
Yeah, like Yogi Berra said, it's deja vu all over again for me. In 1995, I was starting the global program desk at Salomon Brothers. And while that doesn't exist anymore, what was interesting is in the city of London at the time, European equities traded about 80% by the big market makers, and they put up spreads that were completely ridiculous and wide on a system called CIEC International. What was interesting at the same time, 20% of the volume happened on electronic exchanges in markets like Germany and Italy and France. France actually had the first electronic trading system with CATS OS, which traded in Canada and France, et cetera. And at the time, what we saw was a lot of price-insensitive clients who wanted to call their broker, get a price, and then go down to the pub for the rest of the day. And that looks a lot like the market for trading Bitcoin today. 80%, if you believe Tab Group's estimates, and I think they're probably pretty close, trade OTC. And people are price insensitive, and the electronic markets exist, in fact, with greater transparency than they had in those single electronic markets. But that's where we are. Now, where did they go? Well, eventually, 80% of the volume ended up on exchanges trading electronically, where the big market makers and those places still had a space for people who needed capital, and then they became part of that ecosystem. And I expect to see that development in crypto, but we're really sitting somewhere around 1995 as far as the way the crypto markets are going.
So like a crypto market that has absolutely no rules, Dave violated my rule, which was introducing himself before he gave his answer.
Dave Weisberger, CEO of CoinRoutes. And apart from, after doing a lot of stuff with quantitative trading, I ended up running StatArb for Citigroup and then ran market making for 2 Sigma. A couple of years ago, my son actually, who has been programming for about 12 years, had the idea to build a company to aggregate data and be laser focused on best X. And so CoinRoutes was born, and we offer algorithmic trading solutions and consolidated market data for trading digital assets, namely crypto.
Interesting. Second generation crypto in the family.
Yep.
You're after, though. You're the father. You're after him.
Yeah, his idea, but he was looking for someone who knew a little bit about market structure and maybe had a little bit of money to fund it. And, he found me.
That's great. So thanks very much for that, Dave. So Ilya, you're in the quant space and you are multi-asset. Do you see similarities or differences to other markets as this emerging market develops and you work with the existing community, with existing tools, with this new emerging market?
Sure. First of all, let me introduce myself. I'm Ilya Gorlek. I'm a CEO of a company called Deltix, and it's really a pleasure and honor to be here because it's a very exciting opportunity to talk about similarities and dissimilarities. What Deltix we do, we work with traditional quants. And we've been doing it across all asset classes for the last 15 years. And we accumulated a lot of knowledge about what really matters for quants. And we came to crypto relatively late, only like 18 months ago, when it became clear that the asset in itself is interesting. And so we've been asked by our users, our quants, to connect to exchanges and start looking into this market. And what's definitely similar is that there's a lot of challenges. And our users are brain-powered people, and they always want to find opportunities to make money fast, so their horizons are short. And volatility is amazing, obviously, opportunity for them. So from that perspective, volatility of crypto is definitely very enticing, especially when, in the last 5 years, equity markets were quite stable. What's different is, of course, state of technology and state of readiness of the marketplace. Because if you go to traditional exchanges, CME or ICE or New York Stock Exchange, there'll be the whole spectrum of tools and technologies designed for quantitatively minded people with fixed certifications, with the great APIs, with a lot of collocations. In the crypto world, it's Wild West. Everything from WebSockets to unknown protocols. So that is where I see the dissimilarity, and hopefully soon it will be changed, but the data, as we talk about it, that would be the first place to look at.
So you mentioned challenges, which we'll definitely hit on through the panel for market participants and providers. And volatility is great until you can't model it and understand it on some statistical level. So, Kate, you're a provider of software technology, charting, many great tools in the traditional markets, and are looking at this space as well. How is it coming around for you as market participants look to really evolving the tools and tech, either taking what exists today or evolving it to something better that's more fit for purpose or net new in these early days?
Sure. Hi, everyone. I'm Kate James from ChartIQ. I run our institutional sales here in New York. For the past 7 years or so, our firm has been focused on building data visualization and desktop technology for capital markets, both into the retail space, big players like E-Trade and dozens of FX retail exchanges around the world, but also into the institutional space like Citibank and HSBC, Deutsche, Bank of America. So we're in a pretty unique position to see the type of tools and technology that retail traders and crypto traders are using, but also the level of sophistication that's expected on the institutional desks from that technology. A few years ago, when crypto sort of exploded on our scene, on our radar, we realized that we could help elevate that technology experience and sort of help educate our crypto clients on what the institutional traders need to see from a data, from an analytics standpoint. I think from a big picture point of view, and we probably have had upwards of 100 crypto clients, crypto-related clients over the past couple years, the rate with which we see exchanges and coins come to us has slowed pretty dramatically. And there's been a shift into platforms that aggregate price across multiple exchanges and provide smart order routing or best execution. And so we've seen the community sort of come out of the typical asset classes like fixed income and equities and the platforms that they provide, and sort of come around the crypto space and start to pull those platforms together.
Thanks. You've heard brief mentions of retail. It is interesting because other markets started one or the other and evolved to one side or the other maybe over time. This seems like a moment where both markets are developing simultaneously, which has implications for the types of tools you have, as well as the regulations, et cetera. And when you speak to someone who works with E-Trade, works on foreign exchange and equities, and also covers Citi, it really is an interesting blend. So we're going to move on to just the topic generally of price discovery. You've heard fragmentation used a few different times today, multiple times, many times. And again, there's these retail institutional divides or global divides or over-the-counter and exchange divides in terms of how this is going. But is the data available today too fragmented? Is it too hard to access? Is that just the nature of an emerging market? Or are we getting something wrong or just not right enough? Or is it just early? Dave, maybe I'll kick it to you first.
Well, that's literally all we do. So too hard? Well, I mean, obviously we do that for our clients. To give you an idea of how important it is, people, you walk around the city and you see, Gemini's ads saying, fragment, out of chaos. And just to understand how the market goes, this morning, as Tim Massad was speaking, the price of Bitcoin dropped around $200. But it didn't drop $200 in the way we would all think of it. In fact, what happened was on a couple of exchanges, we saw the price drop $200, or on other exchanges, the price dropped only $100. And in the ensuing 15 minutes, there were I think it peaked at about $140 difference between where the best bid was higher than the best offer among the 5 exchanges that are actually regulated by money transfer businesses in the United States that we're covering right now. And that sort of event happens all the time. Many of you have seen me write about this. The fact is you can get this data, but most people haven't gotten it. And so that's one example. Another huge example is something that I saw yesterday. During yesterday's market, when the market was banging at 11,000 but not able to get through the first couple of times, I happened to be doing a demo. And in that time, I saw that if you looked through 800 or so price levels, and we consolidate thousands of price levels in our software, you saw that the book was overbalanced. There were about double the amount of shares, double the amount of Bitcoin available to buy, up to about $10 or $15 million worth of Bitcoin than there was to sell. Now, we've done studies on this, and quants will not believe me, and humans won't really know what I mean, but there's almost an 80% forward correlation in absolute space to when that book becomes that overbalance, that it's going to move in the direction you expect. And sure enough, when I was looking at it, it failed and dropped $40 or $50, and I wasn't remotely surprised. That correlation is so high that I actually told people that that was what was going to happen. Now, every quant knows you would never do that, because a good quant signal, somewhere is like 1 out of 5 times if it happens to be right. You're probably pretty happy with that. And I know that sounds counterintuitive, but it has to do with risk management. So deep in the data, it's available, but it's hard to put together, and that's why we do what we do.
So between the suspect quants and the nervous humans, as a physicist maybe, so what do the quants think, Ilya, in terms of
Sure.
what are they doing with this?
Right. I would like to add to this exactly subject. You see the data, right? There's numbers, and the numbers flicker, and they all over the place. But what does it mean to you as a quant? As long as you can execute, as long as you can reach out to the opportunity to take advantage of that, then you definitely should enjoy it. If not, it only creates anger. So basically, the traditional anger because you cannot take it. So if you think about traditional asset classes, equities, for example, then the alpha generation models, clearly the dominant spectrum of the research, because people have patterns, they have sort of confidence, and they look at patterns and they try to take advantage of it. In the crypto world, at least according to my knowledge, there's absolutely no alpha generation at the moment. There's no point to do it. Buy low, sell high. That's what pretty much 90% of quants do, because exactly of that, what we call arbitrage hill. If you look at basically put the world order book, and it's always going to be cross. Maybe $5 for Bitcoin, maybe 50, maybe 1. It will be always cross, and there's always opportunity, and it's a kind of holy grail because it's a kind of almost guaranteed profit if you can take advantage of it. And also, the worst part about the whole game is that most exchanges, they today promote the volume, right? So if you trade $1 billion, you got commission 0. If you trade 1 Bitcoin, your commission is 20 basis points. Clearly, it's unfair game for people who trade a lot. So the more you trade, the less your commissions, the more you trade, the more you can take opportunity for arbitrage. So we see all this all the time. I wouldn't call it quant. I would call it, at the moment, more like fast runners, but that's the state of the industry, according to my opinion.
I'm sorry, but I have to jump in, the no holding back part of the introduction. The vast majority of time you can't arbitrage because those fees are larger than the arbitrage. Exactly. It does occur. One of the very interesting points about crypto market structure, and this is hugely important, is that the tick size is very small. Now in Bitcoin it's a penny, in XRP it's 8 decimal places. So that tick size being small has 2 very important implications. Number 1, fees in every other asset class are a fraction of the tick size. In crypto, fees are a multiple of the tick size, and this matters. In fact, it's 2 orders of magnitude plus larger are the fees to the tick size. And there's lots of reasons why that matters. I could spend way more, we're not going to go into that. Second major implication, with the very small tick sizes, creates incredibly large number of price levels. So consolidated views that look at 10, 20, 100 price levels don't show the whole market. Exactly. That's one of the reasons why there are alpha models actually in crypto, but you need to do a lot more work to get at that data. That's one of the things that we do. I don't sell the alpha model, I sell the data, but the reality of the situation is there are things that one can see, it's just different. The other big alpha model in crypto that people are using is social media and sentiment, because that's the biggest one. We have nothing to do with that, truth in advertising. I just know that people are doing that, but that's much more of a lower frequency. It's not a market data.
Right, it's not alpha model, it's fundamental, more like, it's not within horizons of hours or minutes.
Sorry, Brad, but just wanted to clarify those 2 points.
Kate, if you want to jump in.
Sure.
On, we're talking, I personally distinguish between investing and trading. when you're talking about a new market and something that is arguably new and maybe going up in value sort of from the bottom left to the top right over time, you can take views that it's going down for moments. It's hard because that gets away from you, or it's just very high cost to transact. So there's a fundamental investor view that this is a new asset class going up versus a trader view that may want to take either side of the market. So I know the tools it's early days, and that is a very traditional concept in the equity markets, going short. You can cheaply execute short, but it could be very expensive to be short from just a financing perspective if you're wrong for a long period of time, and obviously you can grow your losses infinitely. But are there tools being developed today that get to because right now we're in more of an investing phase than a trading phase based on both volatility and maybe this asset class is just going up in value over time and hard to take a two-sided view other than a moment of arb?
Well, I hail from Thomson Reuters before I joined ChartIQ, and during that time walked hundreds of trading desks. And there have been, several of my former clients who have left major trading operations at Millennium, Cantor Fitzgerald, Knight, State Street, and have gone into the digital asset world to trade because they are able to sort of capture that alpha from the liquidity that they were able to see in their early career, of equities or fixed income. And so there are plenty of firms out there that are actually already finding that alpha and doing plenty of trading versus investing. And what they would say is that the technology is almost there, that there are enough platforms and technologies like CoinRoutes and Tagomi, Voyager and Caspian, basically covering the OMS, EMS, pre-trade analytics. They have all of the technology and the tools basically at their fingertips already, and the trade workflow largely looks like it did when they were on the equity and fixed income desks. I think that I would argue that the last frontier is even with custodian services, that there's new technology called MPC. I'm not totally familiar with it, but you don't have to worry about picking cold or hot wallets. You get to the best of both worlds. And so we live in this age of really dynamic and sort of fast accelerating technology, and all of those sort of traditional components of the trade workflow are going to be there. And I would argue that the quality of the data is the last frontier.
Is the connectivity there, would you say? The platforms, the systems are there, but are they all connected in a way where information can move around still, or is that still on the come a bit?
The traders I've spoken to don't seem to have a problem finding the information that they're looking for.
Is the connectivity there is one of those great questions. The answer is, if you know where to look and you put it together, yes, the technology is there. There are a lot of exchanges out there. They have a variety of tools. There's different levels of experience. I mean, Matt Trudeau from RSX is here. LMAX is here. They're much more what we would call traditional. Now, I don't mean traditional in the bad sense or the old sense. I mean a traditional in the sense of a robust sense. There are other exchanges that we connect to. I can tell you we've had conversations. So we have algorithms, and our algorithms do a lot of work. There are exchanges where you could place an order, cancel an order, get acknowledged that cancel happened, get a message that says, okay, you are canceled, and then seconds later receive executions.
Exactly.
So we're connected, but it reminds me, once again, deja vu, reminds me of working with Larry Leibowitz on the original DOT system back in the 80s, where the DOT system on the New York Stock Exchange used to do exactly the same thing, only in their case it was 15 or 20 minutes you could receive an execution after you got a cancel.
I would like to add, if possible, about this
topic.
But obviously there's connectivity because, there's the wires. But I don't know how many of you know concept of rate limits. Let's start from the very basic concept of rate limit, right? What's rate limit in the world of crypto? It means how frequently you can ask for price or how frequently you can get update about state of your order from exchange. So if you, in most exchanges, are not very generous at these rate limits, in most cases, the rate limits becoming a completely detrimental for any systematic traders because you can get maybe 5 updates per second if you're lucky. So what people do, they create fake IP addresses, they create fake accounts, they create all basically incredibly sophisticated set of tools, and they're proud about them because these tools allow them to be more efficient and more creative and more smart, and that's exactly the state of the industry.
Yeah, let's
So-
not use the word fake. Let's say randomized
Well,
IP and
Well, but
infrastructure.
fake from perspective of fake ID, right? If you get driver's license, you get one. If you get 5 of them because in the morning I got this license, in the afternoon this. And obviously people don't do it because they have to, because they just they're being forced. Exchanges, if they were supporting regulated fix, if they were thinking about people who really use them for systematic purposes, they wouldn't do it. But it's a kind of chicken egg situation.
Yeah, it's funny story. So we have 500 proxy servers that randomize and poll exchanges that actually don't give you a feed. So we had real-time feeds for exchanges that don't have real-time feeds. And I remember at some time ago, before they had a WebSocket feed, going into Kraken and showing them our data feed, which was multiple seconds faster than their own data feed. And they were trying to figure out why this was the case. And I said, well, it's easy because we have 500 servers that are coming at you and doing it this way. And they're like, oh. And the business development people were laughing. The technology people were less than amused. But that is something that Ilya is 100% right. You need to do that sort of stuff.
Or
in the crypto world.
star light. You see the light, it comes to you, you think it's now, in reality it's 2 seconds ago because it's a coalescent data feed. They aggregate everything, publish to you, they show you timestamp as if it's now, in reality it's 2 seconds ago. Go figure out. But it's connectivity, sure.
Yeah. So
But
for
again,
those with teenage, I have Finsta, if you're familiar with Finsta, my daughter's fake Instagram account, which is the one with smaller people and more dicey posts, which I found later in life. So Finsta, for those with teenagers, it's the fake Instagram account. It sounds like I'm telling you something you should already know. So let's talk pre-trade, trade, and post-trade data. We think about it as linear. You've done it. You're thinking about doing a trade. You do a trade, and then it's reported somewhere. In our panel prep, we talked about more of a circle of life, or a virtuous circle. So maybe we could talk a little bit and I think it's come up in our survey questions, pre, post, at trade, books. What do we think, what does that space look like in terms of the beginning and the end? Or where are we in post-trade mattering more than pre?
Well, pre-trade is something that we've spent a lot of time on. I mean, I believe fundamentally, having spent 10 years building algorithms and trading quantitatively, that if you don't have good pre-trade data and you don't know what you're doing, your algorithms are going to be awful. And in fact, most algorithms in the crypto space are in fact awful. And so what we did is we said, okay, well, what's the most important thing to know? And frankly, the most important thing to know is consolidated book data to a significant depth. And that can be gotten. What is interesting is we've seen really differences between the exchanges and where the OTC dealers forecast their prices at times. So CoinDesk, for those of you who don't know, the feeds that they put up on their page are coming from dealers. And so if you compare our feed to their feed, you can get an idea of, are the dealers long or short? And believe me, when there's massive divergences, the market's about to move very large. And it depends on the spark and what's going on. So there is a lot of pre-trade data. The difference is most of the technologies, unless you're quantitative like Ilya or you're focused on crypto from the ground up like we are going to miss that. So understanding what your expected cost to trade could be is extremely important in crypto. But here's the key. People have asked me many times, what's your biggest competitor? And our biggest competitor is apathy/stupidity. And the reason is because most of the people in crypto, and I talked about it before, most of the big traders tend not to care about price so much. They just want to be safe, and they just want to get things done. So really, what's going to drive better pre-trade tools and better pre-trade data and more adoption is people actually caring about price discovery and caring about best execution.
I can just jump into this only for 1 second. The data, right, if pre-trade data, is also very important. What's the amount? What's the volume on the market at the current time? Because you look at the data again and you don't pay attention to volumes, it's exactly the border book and BitMEX 3,000 level deep. So if you look at 3,000 levels ask and 3,000 levels beats, somewhere in between there will be some sizable orders which basically will be important. If they're close to the top of the book, of course, then it's a kind of closer to executable prices. If they're deep in liquidity and you don't see them, you don't have idea what actually happens in the market. So you need to always analyze what's the average price of execution, 10 Bitcoins, 20 Bitcoins across exchange, across markets. Some exchanges don't even have capacity to run 10 Bitcoins at all. If you look through the entire book, they'll be just naked. So pre-trade data is relevant only for purposes of what you're going to do about this data. If you're thinking about trading later, then of course it's important. If you're just going to enjoy it, then probably it's not that important.
So we think that pre-trade data gets everybody to the party. But if you want the rave to last all night, you've got to serve them up some good post-trade, cost analysis and data that's going to make sure that the market isn't manipulated and that they're not losing out.
And then after that party, how do they get home?
How
Is
do
it
they
just
get home?
somehow
Probably Uber.
a drone? Yeah, maybe autonomous at that time. So just moving a little bit on, so there's over-the-counter markets, exchange markets, a lot of discussion about regulation. You could argue that the pre-trade's the most important to get the party going, but then people understanding what happened to my order in the market after, or might my size impact the market as I'm getting it done, which sounds like it's more second and third order, but that's probably when things get real, when you're thinking about TCA and best execution, which is when people, to your point, Dave, start to care about price. But let's pivot a little bit to the regulators. The regulators in the world are talking about regulating data generally. I think the Facebook initiative has certainly thrust the data regulation and the crypto into one somewhat joined up conversation. And then you get into what is regulation for? Is it about protecting retail, or is it about something different, creating markets or just protecting people in markets generally, or not sure. But let's just talk about regulation a bit because it's so topical. It's come up a number of times today. It's going to have a role in the data end of this market. The only question is how and when. And you can go wherever you want, geographically, over-the-counter exchange. Again, my guess is exchanges will lead the way on this because they're in a box and you can regulate them.
Well, look, my biggest pet peeve, and I don't know if Gabor is in the audience because I've been trying to tell him this for about a year. My biggest pet peeve is the whole ETF deal with the SEC. And the reason it's a peeve and not anything else is that the following are two very important facts. Important fact number one, the market for Bitcoin and Ethereum is significantly more transparent and actually regulated than the market for most of the commodities, which they have commodity ETFs. So that is factual, and I agree with the Bitcoin industry on that, pretty wholeheartedly. The second fact is the SEC looks at the market structure for an electronic market like Bitcoin and is absolutely appalled at the disconnect between OTC market makers, exchanges, and exchanges with each other. And they don't have jurisdiction over Bitcoin and Ether, but they all, to a person in that building, believe they should, because they think they're trying to protect investors. And so you have this huge irresistible force and movable object thing going on where the Bitcoin ETF decision is a proxy for market structure on Bitcoin. In Enter Crumble My Coin routes, for over a year, we patented this idea of something called real price. We can put up on a screen the cost to buy or sell the full creation unit for Bitcoin. So say 350 Bitcoin or $3 million worth, whatever that is, we can tell you with absolute precision, based on whichever fee rate you want. If you're the SEC, it would be retail fee. We could, with precision, give you a data stream of exactly what does it cost to buy or sell that, fully executable prices. Yet somehow people are using things like OTC quotes, which are not actionable, which can't be audited, which the SEC wants to audit and can't, to try to get the Bitcoin ETF approved. So my head hurts on this topic. It is the most fundamental question. Why is it that an asset that's that transparent can't be approved as an ETF? That to me is one of the most important ones when the data is absolutely available. And in fact, I have it on my screen. Anyone who wants to look at my laptop, I can show it to you.
For me, the issue is slightly different. The most enjoyable part about cryptocurrency is the fact that exchanges, for example, don't put any restrictions on who can use this data, at least at the moment, and how the data can be distributed. And it's 24/7. Of course, it's super exciting and democratic. The problem I have today with exchanges, that their commission structure is incredibly complicated and completely random. And that commission structure is not represented in the price data. So if you look at prices, you have no idea what exactly it means to you because the commissions at exchange is actually a significantly viable component of the whole game. Unlike equity or futures or even FX where commissions are clear and they small comparing to the big game, in crypto world, commissions define everything. And because they define everything, knowledge of commission is imperative. and it's not representing the price, and it's not even regulated, and it's not even clear, and exchanges change these commissions at random. And to follow that, that's a difficult part. So if anything, I would be saying about regulators, if they can at least do something so that exchanges don't as frequently change their commissions, that would be great. Otherwise, I'm very happy that regulators don't do anything with how exchanges publish their prices and how they form their kind of what they stream out to the world.
And Kate, is there an active dialogue going on between the providers of the endpoint from a technology perspective and the liquidity pools, the exchanges, or even the OTC platforms, or is it kind of driven by what people are asking for and you attempt to push out there and develop something?
Yeah, I think it's difficult to, well, first of all, you have this sort of dichotomy between the people who developed crypto, right? The ones that the sort of, you know, anarchists in their own right, and they want this decentralized currency, global sort of currency. But there's really, and then that just goes directly against regulation. I think that goes without saying. But then, you know, you have the way that regulation sort of developed over all of the other asset classes was over a great amount of time when a lot of the market structure was much more stable and sort of mature and developed. And we're talking about an asset class that's, you know, existed in the way that it does right now for maybe 3 years. So there's almost too much technology and the regulation is going to be hard to catch up.
Yeah, I mean, there may be an analog in derivatives where it was a very global, unregulated market for decades, and over time it's become much more regulated and regional, and the tools and tech had been there prior, so maybe there's something in that. So in the last minutes, we'll move to conclude a bit and give some open-ended questions and our panel members a chance to roam a bit. So, and I'll give two and you can choose. So from a data-centric perspective, you know, the single most important area to progress to reduce what is called FUD, around this business, the fear, uncertainty, and doubt, not to be confused with FOMO, which is different, in the crypto markets over the next couple of years. We've heard custody today, we've heard regulations, maybe it's just an evolution of tech, or what is the coolest development you'd like to see make crypto more easily accessible and investable, and what is the data angle to help make this a reality? So I'll just open it up, and my guess is we'll be just about done. 40 minutes, Chris. Where's... I think I'm on time, but we'll move.
So there's a good amount of evidence out there that, I think you guys were alluding to this, that the exchanges, not just in the commission structure, but in the generally accepted financial metrics are sort of not adhering to what we think about when we talk about traditional markets, right? So there's good evidence out there that a lot of the exchanges, maybe except the top 10 venues that are sort of looked at as the adults in the crypto world, are largely inflating their trade volume. And this, you know, this is because it's in their best interest to inflate trade volume because there's no regulation around it, right? They don't have to adhere to any sort of rules or regulations right now. But the way that they're incentivized when they list coins, I mean, their fees are anywhere between 1 to 3 million, and so it's really in their best interest to lure the coins to list with them by showing that there's all this liquidity and sort of a movement and potential for that coin. And I think that if they want to be taken serious by institutional investors, then they're going to have to sort of, you know, come to terms with basic things like trade volume.
Ilya? Or Dave?
Well, you know I can talk, so do you?
Well, the question is what I think would be the cool thing for the industry, which will promote institutional audience to get into cryptocurrencies. I think what would be cool if there will be some level of safety and security. If people understood that this asset class will not going to be killed or crashed by some sort of big monstrous political power. I believe that there's a lot of people, especially when I travel around the world, and I see the people who really have no bank accounts because they can't have them, because it's too expensive to move money between the world. I would think that it would be fantastic if the needs of real people could be merged together with institutional people and create stable asset class, which is not going to be feared that somebody's going to hack it or crash it or just make it illegal.
So like Facebook, Libra, Calibra or not, it's definitely brought that debate to the fore.
Right.
the unbanked.
I personally feel it's a great thing they do
Yeah.
it. I think personally it's fantastic what they're trying to accomplish, and it definitely creates a sense of stability and sort of order.
So I'd go to two things. First, I want to react a bit to what Kate said. I think it's really important to understand that as long as there is an ability to do things like fake volume, which could manipulate how algorithms work, et cetera, understand to the extent that someone's algorithm or trading can be manipulated, people will do it, and therefore you need to be incredibly well aware of it, and so choose your providers carefully. It can be done. My answer to your question, Brad, is better aggregation across exchanges requires better mechanisms to trade. Now, I've counted at least 8 groups, and several of which we're under NDA with for obvious reasons, that are facilitating or working to facilitate pan-exchange trading, giving credit from a central repository, giving credit from exchanges across each other to do multilateral trading. That absolutely will help in terms of the ability to trade across different venues, without a doubt. Now, the reality is you can do pretty well if you have a couple of exchanges taking advantage of the fact that exchanges prices tend to mean revert. But the number one question we get asked is simple. Do you have to have coins on every exchange and dollars on every exchange in order to take advantage of your software? And the answer is actually no. And for people who want to understand why that is, happy to explain off the line. But what the more meaningful question is, more people are getting into the business of making the answer to that irrelevant. So the ability to trade across venues and aggregate together so that the data becomes more meaningful, that to me is something that is a short term, namely in the next year or so, you will see that more and more. And I think that will do a lot to inspire investor confidence.
Thanks very much. Thanks to my panel. So it's early, it's real, but still very much evolving. Data will be at the heart of it, as it always is in any markets. And it will ping pong back and forth with the regulations and the market providers and the market makers. So thanks for your time. And I think we'll move on to our next panel. Thanks, Chris.
Thank you.